First, welcome to our deep dive on traditional versus Roth 401k strategies. In this video, we will explore how tax deferral can accelerate wealth building, when Roth makes sense, and how to blend both for maximum flexibility. We will also include real-world scenarios, clear comparisons, diagrams, and quick quizzes to help you lock in the concepts. Next, here is our roadmap so you always know what is coming. We will begin with the big picture, then examine traditional and Roth mechanics, visualize tax arbitrage with diagrams, compare options, and look at tax brackets. After that, we will cover when each account shines, a pro strategy called the mega-backdoor-roth, a couple of quick quizzes, a case study, an important disclaimer, and finally a concise wrap-up. Now let us frame the decision. The essential question is whether you should pay taxes now or later. If your current marginal tax rate is high, deducting contributions into a traditional 401k can create meaningful savings today. In retirement, withdrawals typically begin at the lowest brackets as you fill them up, which can create a spread between the tax you avoided and the tax you eventually pay. That spread is known as tax arbitrage, and it can materially boost your after-tax wealth. Then, let us examine the traditional 401k. Contributions go in before taxes, reducing your taxable income for the year. If you are in a high marginal bracket, the immediate tax savings can be substantial. Your investments grow without current taxation, and in retirement, withdrawals are taxed as ordinary income. Importantly, you typically withdraw by filling the lowest tax brackets first, which can lead to paying a lower average rate on those dollars than the rate you avoided when you contributed. That difference is the essence of tax arbitrage and is a primary reason high earners often prefer traditional contributions. After that, let us look at the Roth 401k. You contribute after-tax dollars, meaning you pay the tax upfront. In retirement, qualified withdrawals are tax-free, which is highly appealing if you expect your future tax rate to be higher than your current one. Roth can be especially effective in low-income years or early in a career. It also adds tax diversification to your retirement plan, increasing flexibility. However, it is important not to choose Roth solely because the phrase tax-free growth sounds attractive. If your current deduction is large and your retirement tax rate is likely lower, the traditional option can be more advantageous. Meanwhile, this diagram illustrates the tax arbitrage sequence. On the traditional path, you contribute pre-tax at a high marginal rate, realize immediate tax savings, allow the balance to compound tax-deferred, and then withdraw in retirement by filling lower brackets first. The average tax rate you pay in retirement may be lower than the marginal rate you avoided, producing a positive spread. On the parallel Roth path, you pay tax now, contribute after tax, and withdraw tax-free. Roth wins when your future tax rate exceeds your current rate. The diagram emphasizes that conditions determine which path is superior. Next, compare them side by side. Traditional provides an immediate deduction, tax-deferred growth, and withdrawals taxed later, typically beginning in the lowest brackets. This often favors higher earners who are maximizing contributions. Roth, on the other hand, requires paying taxes now with the benefit of tax-free withdrawals later. This tends to be attractive when you expect to be in a higher tax environment in retirement, or during years when your current income is relatively low. Both contribute to diversification of your tax exposure in retirement. Furthermore, this simple table illustrates concepts rather than precise tax liabilities. A high earner who contributes to traditional avoids a higher marginal rate today and may pay a lower average rate in retirement, producing a positive spread. Conversely, a high earner contributing to Roth pays a high rate now, which is only advantageous if the future rate is higher. For lower earners, Roth often makes sense since the current rate is already low and tax-free withdrawals later are very valuable. These are general patterns. Actual brackets and thresholds change and depend on your filing status, location, and future laws. Consequently, traditional often shines when your current marginal tax rate is high. If you are diligent about maximizing contributions, you capture a large deduction and let the money grow tax-deferred. In retirement, if your expenses decrease and debts are paid off, your taxable income may naturally fall, allowing you to fill lower tax brackets first. This sequence tends to make your average retirement tax rate lower than the rate you avoided. In contrast, Roth shines when you anticipate higher future tax rates or find yourself in a low-income phase today. Paying tax at a lower current rate can be favorable if your retirement income will be robust, if you expect higher federal or state tax rates, or if you value the simplicity of tax-free qualified withdrawals. Roth dollars also diversify your future withdrawal options, which can aid in optimizing your tax profile across multiple income sources. Moving on, the mega-backdoor-roth allows you to contribute after-tax dollars to your 401k beyond regular deferral limits, then convert those dollars to Roth either in-plan or via an in-service distribution if your plan allows it. The goal is to expand the amount that ultimately lives in a Roth environment. Key steps include verifying plan features, contributing after-tax funds, converting promptly to limit taxable earnings, and coordinating carefully with your plan administrator to maintain compliance. Next, here's a quick quiz. The question is, if you are in the 24% marginal bracket today and expect to fill the 0, 10, and 12% brackets first in retirement, which contribution type usually has the mathematical edge? The options are Roth 401k, traditional 401k, neither, taxable brokerage only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now, the correct answer is traditional 401k. The rationale is that you are deducting at a high current marginal rate and likely paying a lower average rate in retirement when you fill the low brackets first. That differential is the tax arbitrage that can compound your advantage. After that, consider another quiz. Which situation tends to favor Roth 401k contributions? The options are: you expect significantly higher tax rates in retirement. You are in your highest earning years with a top marginal rate. You plan to move from a high-tax state to a no-tax state in retirement. You do not want tax diversification. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Then, the correct answer is that Roth contributions are favored when you expect significantly higher tax rates in retirement. Paying tax at a relatively lower rate today for tax-free withdrawals later can be advantageous under that expectation. Furthermore, beware of common mistakes. Do not select Roth solely because tax-free growth sounds appealing. Compare your current deduction against likely future rates. Consider both federal and state taxes, including potential relocation. Maximize contributions when cash flow permits, and explore plan features such as after-tax contributions and in-plan conversions. Finally, coordinate your 401k strategy with other accounts like HSAs, IRAs, and taxable brokerage to optimize overall tax efficiency. Moreover, let us walk through a simplified case study. Suppose a high earner in the 24% bracket contributes the annual deferral pre-tax. They save 24% of that contribution in taxes today. In retirement, if their average effective rate on withdrawals is near 12%, the conceptual spread between what was avoided and what is later paid is significant. Over decades, the compounding on the full pre-tax balance can increase the after-tax benefit. Keep in mind that this is illustrative and not individualized advice, as results depend on changing laws, your income mix, deductions, and state tax considerations. Subsequently, this timeline presents three phases. During working years, a high marginal rate makes traditional deductions attractive. In transition or gap years, especially before required minimum distributions start, there may be opportunities to convert portions of pre-tax money to Roth at lower rates. In retirement, withdrawals often fill the lower brackets first. Additionally, state tax changes from relocation and healthcare costs can influence which accounts you draw from and when. Finally, a brief but essential disclaimer. This video is for educational purposes only and does not constitute tax, legal, or investment advice. Your circumstances are unique. Please consult a qualified professional who can evaluate your specific situation, including federal and state taxes, plan rules, and changing laws. To conclude, traditional contributions often benefit high earners by capturing a large deduction at a high rate and paying a lower average rate later. Roth contributions shine when current income is low or future tax rates are expected to be higher. Prioritize maximizing contributions, then consider advanced strategies like the mega-backdoor-roth. Combine different account types to increase withdrawal flexibility. Above all, saving aggressively is the most important driver of financial freedom. As a final note, if you found this valuable, please like the video, share it with someone who is deciding between traditional and Roth, and subscribe for more. Tell us in the comments which strategy you prefer and why. Your feedback helps us create even better content next time.